Okay, so I think we're ready to get started. Hello, everyone. This is Kathy Lien with BK Forex. I want to welcome you to our monthly non-farm payrolls preview. I'm very excited to be here with you. So I'm just going to go ahead and share with you my screen. And the first thing I want to do is I want to talk a little bit about the price action the market's going into the NFP report. Okay, good. I've been sharing, just making sure everything looks good. You can see that I'm looking at dollar CAD because we were actually bidding to buy Kiwi CAD earlier this morning at 89.25. It dropped to a low of 89.23, but unfortunately that was not enough to it just wasn't enough. Yeah, we were looking for the turnaround, and it did happen, but we didn't necessarily get entered. Anyway, I digress. The point I want to make is that for the most part, the US dollar is down across the board going into the non-farm payrolls report. And the big question I saw an article on FX Street about this is whether it's even going to, non-farm payrolls is even going to matter this month. For the most part, we know where the Federal Reserve stands. We know that they are not inclined to raise interest rates at all. We know that they would in April and probably not even in June. We know that they prefer to wait, according to the comments from Janet Yellen. So in order for non-farm payrolls is really important in the sense that in the sense of how it impacts Fed policy. So at this stage, the only thing that could get the Federal Reserve to suddenly change their minds is if we get 275,000 job growth, with the unemployment rate falling even further to 4.8%, and it's a really big average hourly earnings rises by 0.5% or more. Every single one of these stars need to line up for the dollar to see any meaningful recovery, and for investors to be excited about buying the greenback again. Anything short of that will lead to relatively more of a dead cat bounce in the dollar, in my opinion. So there's definitely more downside than upside risk, because if we do get a soft report and there's any component of the trade missing, then I think there's a very, very good possibility we actually could see a further decline in the US dollar. So those are the couple of things that we are watching for. And it is important that the market, to realize that the market is anticipating a dollar negative release. And at this stage, I think they're looking for anything to reinforce their views that the Fed may not even raise interest rates this year. So euro is above this high here in February. We think that there's a very good chance that it's going to 115, and we're quite possibly going to see further losses in the greenback against many currencies. Dollar CAD's bounced off its lows today. Didn't get as low as we thought, which is this former low here at 32, but it could still get there. So keep your eyes open, because if we have a soft US dollar number, we could see dollar CAD slip all the way to October lows, which is also which is the main support level for dollar CAD. Taking a look at dollar yen is kind of range bound. I think we could see a drop below 112. If it goes to 113-ish, I think it's a good point to sell dollar yen. And then finally, pound dollar. Sorry for these lines. These lines were something that I was looking at earlier. Let me kind of remove them for clarity purposes. Seems like pound's the weakest, and for good reasons. I think pound's nearing a peak. I think pound's probably going to find itself trading back towards 142. So we definitely see a small kind of minor head and shoulders pattern here. And I think of all the currencies, pound is the most vulnerable. And so for this reason, there's a very good chance euro pound could stretch to 80 cents. So these are a lot of things that I'm looking at this morning. I also like pound yen to the short side. I think that, it's bouncing. There's a fib at 162.90. Obviously, that's pretty far away from here. But in the context of that, I think that, pound could easily slip below 160, pound yen, that is. So that's what we're looking forward to. So my favorite trades right now is to sell pounds either against the yen or to sell pounds against the euro, but I'd like to buy euro pound more closer to 79 cents. I've been trying to buy Kiwi CAD, as I mentioned to you. You know, for our members, we had to order at 89.25, almost got it. But I think, dollar CAD still headed lower. I mean, I think, let's see how oil prices are doing right now. Oil prices are up. CAD GDP numbers were strong. I think this is a dead cat bounce in dollar CAD, and I think that we could definitely see dollar CAD move lower once again. So those are pretty significant risks in the markets right now. So non-farm payrolls. In terms of non-farm payrolls, this month, non-farm payrolls is a little bit more difficult to call than the previous months, because typically, if you joined me for the session in the past, you will know that we always look at 8 different leading indicators for non-farm payrolls. And the difference between that and non-farm payrolls is that the 2 most important leading indicators for non-farm payrolls, which is the ISM non-manufacturing index and the ISM manufacturing index, although I would say non-manufacturing ISM is the most important, won't be released until after NFPs. And so it won't be released until after NFPs. And so that doesn't give us as much to work off of as the previous month. But with that in mind, let's take a look at how the other leading indicators stack up. So this is what we do. And while I'm using my Bloomberg terminal, you can easily do this on any calendar. It's just slightly more challenging. I think last time non-farm payrolls was released on the 4th. And let me just expand my calendar. Actually, I don't need to. So let's take a look at how some of the leading indicators for NFPs have fared since the last release. So starting off, I actually prefer to sort like this. Okay, so taking a look at this, you can see we'll start off with the ADP report. So ADP, let me see if I can click on something else. So ADP came in better than expected, but still lower than the previous month. 205 versus 200,000, 214 versus 200,000. So ADP is pointing to weaker job growth for the month of March. Challenger job cuts also increased by 30% in the month of March. Let's see if there's any significance here. This is the largest rise we've seen, looks like, since August, maybe. But either way, the number shows an increase, which is also pointing to weaker non-farm payrolls. Consumer confidence ticked up strongly. That suggests that maybe we'll have a better release. So 2 for a lower number, 1 for a weaker number. Continuing claims we'll look at later when we get an aggregate. Oh, actually, we can look at it now. Continuing claims was previously 2231. Now it's 2173. Actually, continuing claims dropped to its lowest level since October. So this definitely points to a stronger stronger labor market. So 2 for 2 right now. Initial job claims, we have to look at the 4-week moving average, but I can already tell you that the 4-week moving average increased because you can see the last week is 262 versus 276. So the 4-week moving average of jobless claims increased, but the increase was relatively small, but we're still 3 for 2 right now. And then the last one that we have is the U-Mitch index. And the U-Mitch measure of consumer confidence dropped from 91.7 to 90 when it was actually expected to increase. So we now have 4 leading indicators for non-farm payrolls pointing to a softer release, and 2 of them pointing to a stronger release. So to recap, ADP, Challenger, the University of Michigan index, and the 4-week moving average of jobless claims tell us the non-farm payrolls should be weaker. Consumer confidence released by the Conference Board and continuing claims suggest to us that non-farm payrolls should be stronger. Now let's look at the expectations. We certainly have a lot more arguments, in my opinion, in favor of weaker payrolls than stronger payrolls. Also, last month, the number was a blowout surprise. The market, I think, was looking for 190-something thousand. It came in at 242,000, so much stronger than expected. So a little bit of a payback is anticipated. So from a headline numbers perspective, it'll be very difficult for non-farm payrolls to exceed the previous month's number, 242,000. But really what matters is not that, because if we have non-farm payrolls come in around 200,000, unemployment rate holds at around 4.9%, and average hourly earnings increase 0.5%, you're still going to see the US dollar rally. But this is really the key. I mean, will average hourly earnings really increase that much? And we know that wage growth has really been the big problem for the US economy. And from this perspective, I think that there's a very good chance that average hourly earnings may miss. So the bottom line is, I think, for the most part, non-farm payrolls is not going to help the US dollar much. And in fact, I think maybe it'll just increase 0.2%, and you may have a little mild dollar rally simply because investors were relieved that it did not decline. And I think that's pretty much it. I mean, I don't think we're going to see much more beyond that in terms of average hourly earnings growth. So when you wait for tomorrow's non-farm payrolls report, the most important thing to realize is average hourly earnings. And I can prove that to you because on the 4th, non-farm payrolls was a blowout number, 242,000. Average hourly earnings came in minus 0.1%. Let's see how yen traded. And I'm just going to go to the 15-minute chart on March 4th. So March 4th, everyone sees the headline number, 830. They shoot dollar yen higher. But for the next hour, dollar yen declines pretty much 100 pips, because the real key is the average hourly earnings number. Eventually, dollar yen ends up recovering when stocks open, but the quote-unquote true reaction in the first hour is actually dollar yen weakness and not dollar yen strength. So one of the biggest mistakes that you could make is to buy dollar yen after seeing that blowout non-farm payrolls headline number, and not realizing that the most important thing is average hourly earnings. Let's take a look at how euro performed in that same on that same day. So March 4th. So euro is very much vulnerable to this, what we call V-shaped price action, where first it drops because we do have a good number that for the US, or at least the market thinks that it's a good number. So we do see euro dollar drop as the US dollar rallies. But then, shortly thereafter, it ends up verticalizing, and you end up seeing you basically end up seeing the dollar sell off, and the euro, pretty much press higher by more than 100 pips off of its low. So that's really important. And I think that's very much could be the same type of price action we see this time around. Let's take a look at February, just for good measure. February was released on the 5th. Headline number was weak, but the unemployment rate improved and average hourly earnings improved. So did the market care about the headline number, or did they care about average hourly earnings and the unemployment rate? I think you'll probably answer this question yourself. Let's take a look at the charts. February 5th. So we're taking a look at February 5th. So here you can see. So the initial number was the headline number is weak. Dollar yen shoots lower. That's a buy. That was a buy signal because the unemployment rate improved and average hourly earnings increased a lot. So if you bought the decline, you would see dollar yen end up, within the next 45 minutes up more than 100 pips from its lows. And we see very similar price action, I bet, in euro dollar, February 5th. So right here, euro dollar spikes because people think, oh, the headline number is weak, 150 something thousand versus 190,000 affected. Knee-jerk reaction lasts for seconds before euro dollar ends up collapsing because the dollar rallies because you realize the component of the report is much stronger. So that's exactly what we want to see, and that's exactly what we have. Sorry, 1 second. I should realize that my trade is not triggered. Let me just make sure. Okay, so my euro pound long trade just got triggered for our BK members. So let me just get this out to them. And so, you know, we're basically playing pound weakness through euro pounds. And let me just get this out there. So the bottom line with the non-farm payrolls report that I hope you realize is that the key is really, you know, regardless of what the headline number is, the key really is earnings. And you can see that in the last two releases, because the problem with the U.S. economy is that there's weak spending. And weak spending obviously means weak growth. And a large part of the weak spending is, you know, very much caused by the fact that wages are weak. And it's all a cycle. If wages start to improve, then what you're going to see is spending start to improve, which, you know, then hopefully will lead to growth starting to improve in the U.S. So if we do get an improvement in wages, it is very much a virtuous cycle, and it's what we, you know, look forward to, and that's why is such an important release, in my opinion. And that's why when it comes to tomorrow's report, the game plan is, you know, first you're going to see the knee-jerk reaction to the headline number, but what you really should be, quote unquote, reacting on is the average hourly earnings number. So if the market has a complete inverse reaction and ignores the average hourly earnings number first, then that's the, you know, then, you know, you can basically either sell the dollar on a rally or buy the dollar on a dip. But even if you miss it, you can see that when you have the reversal, typically it will last for, this is a 15-minute chart, it will last for at least the next, let's see if we can get a little granular, March 4th. Let's just look at dollar yen on March 4th. I'm going to go March 4th to March 5th. So go March 3rd to March 5th. Okay. So this is obviously non-farm payrolls over here. And these are these are 2-minute candles. So 8:30 right here. In the first 5 minutes, you're already seeing the reversal. So if you wait 5 minutes, or even if you wait, see on this chart, I think it's probably easier. If you wait 15 minutes here and you wait for the dust to settle and you sold this move because you realize, in the market, what really happens, the market thought that the number was dollar positive and euro negative. You sold here at 111.60. You still had about a max move of 50 pips in the euro dollar. Dollar yen on February 5th. We'll look at February 5th first, sorry, and then we'll look back at March 4th. Well, actually, let's just look at March 4th since we're here. So you can see if you waited for the first 10 minutes, you saw the market didn't care about the number that much. It's sharp reversal, not continuation. If you sold that, you still had a very nice continuation in dollar yen. And let's look at February 4th. So February 4th or February 5th. So here's the non-farm payrolls number. So dips, closes, even if you bought the high one or you bought the close 117, you still had another 40 pips in continuation. I think the bigger moves do happen in euro because we saw the euro, and let's look at the euro March 4th. So even if you didn't know how to digest the data, you can see the first 15 minutes we had a drop, then we bounced, and you realize the details were actually dollar negative. So dollar negative, euro positive. So we bought the close. You still had a nice little continuation. So the point is you don't have to push the go button as soon as you see the non-farm payrolls release. You have some time. There's no need to rush. And that's really the key. Whenever we live trade non-farm payrolls, which we do with our members, BK members every single month, it's all about waiting and setting out orders after non-farm payrolls because we always have the opportunity to wait. In terms of digesting the data, I think I've already shared with you that the key is the average hourly earnings and not so much the headline release. So with that, I'd like to open up the floor to any questions that you may have. No questions about anything that I talked about? Okay. All right. So NFPs is coming out tomorrow at 8:30, Cornel. I hope that you know that already because it is the most important release on the calendar this month. Okay. Thank you so much for having me. I hope you found today's webinar insightful.